The CEO of the world's largest oil company just walked into the White House and told the President of the United States one word that could change everything about America's energy future. Uninvestable. Venezuela has more oil than Saudi Arabia, more than any country on earth. 303 billion barrels sitting in the ground. And yet, when Trump asked for $100 billion to unlock it, Exxon CEO looked him in the eye and refused. What happened in that room? And why should you care about a meeting between oil executives and politicians? Because the promises being made about your gas prices right now are built on a foundation that just cracked wide open. Last week, President Trump convened an emergency meeting at the White House. This wasn't a press conference. This wasn't a policy briefing. This was a direct sit-down with the chief executives of America's energy titans. In the room, Darren Woods from ExxonMobil, Ryan Lance from ConocoPhillips, Mark Nelson, vice chairman of Chevron, representatives from Spain's Repsol and Italy's Eni. Shell CEO Wael Sawan joined from Europe. The administration's pitch was straightforward. Venezuela's oil industry has collapsed. The nation is now under new interim leadership following the January 3rd U.S. military operation that captured Nicolas Maduro. The United States has effectively assumed control of Venezuelan oil operations. Trump wants American companies to flood the zone with capital, $100 billion in investment, rebuild the infrastructure, restart production, unlock those massive reserves, and in return deliver lower gas prices for American families. That was the vision he presented. What he received was something vastly different. Darren Woods spoke first, and his words landed like a brick through glass. He reminded everyone in that room that Exxon has had its assets seized in Venezuela. Not once, but twice. Their equipment, their facilities, their investments confiscated by the government without compensation. Then came the phrase that should be reverberating through every energy policy discussion in Washington right now. Today, it's uninvestable. Let me be clear about what that word means coming from someone like Woods. This isn't a man who avoids risk. Exxon operates in some of the most challenging environments on the planet. They drill in deep water. They navigate complex political situations. They've operated in conflict zones. When Exxon CEO declares a country is uninvestable, he's not being dramatic. He's reading from a spreadsheet that doesn't lie, and he wasn't alone in his skepticism. Ryan Lance from ConocoPhillips emphasized that his company is still owed nearly $10 billion from Venezuela's previous seizures. That's capital awarded by international arbitration tribunals, legal judgments that Venezuela has simply ignored. Exxon is owed more than $1 billion through the same process, while ConocoPhillips is seeking to recover over $10 billion. So when the president asks these executives to invest fresh capital, he's essentially asking them to trust a country that still owes them approximately $12 billion combined. Consider that from a pure business perspective. Would you lend money to someone who already owes you and has shown no intention of repaying? Would you double down on a relationship where you've been burned not once but twice? That's the calculation these executives are making. And right now the mathematics doesn't work. To understand why these companies are so reluctant, you need to understand Venezuela's oil story, one of the greatest resource catastrophes in modern history. In the 1990s, Venezuela was pumping 3.5 million barrels of oil every single day. They were an energy powerhouse. Foreign investment flowed in. Infrastructure was modern. Technical expertise was abundant. Then came Hugo Chavez. Under Chavez, Venezuela launched what they termed a nationalization campaign. Foreign oil companies were told they had a choice: accept minority partnerships with the state-owned company PDVSA or leave. Some companies stayed: Total, Chevron, Statoil, BP. They accepted reduced stakes and maintained their operations. Exxon and ConocoPhillips refused. They wouldn't accept terms that stripped them of control over their own investments. So Venezuela seized everything: refineries, equipment, pipelines, facilities built with American capital and American expertise confiscated overnight. The companies took their case to international arbitration. They won. ConocoPhillips was awarded over $10 billion. Exxon was awarded over $1 billion. Venezuela never paid a cent. That was over a decade ago. Those judgments remain outstanding. Now fast forward to today. What does Venezuela's oil industry actually look like? Production has collapsed from 3.5 million barrels per day to approximately 800,000 to 1 million barrels, roughly 0.8% of global crude production. That's a decline of over 70% in less than 30 years. And it's not just that they're producing less oil. The infrastructure itself is disintegrating. Equipment has been cannibalized for spare parts. Pipelines are corroded. Refineries are operating at a fraction of capacity, if they're operating at all. The technical workforce, the engineers, the specialists, the people who actually understand how to run complex oil operations, they fled the country. Venezuela's oil industry isn't just underperforming, it's disintegrating. Industry analysts at Rystad Energy have run the numbers on what recovery would actually require. Just to restore production to 1990s levels would require approximately $183 billion over more than a decade. And that's assuming political stability, that's assuming legal protections, that's assuming a functioning government that honors contracts. None of those conditions currently exist. David Goldwyn spent years as the State Department's Special Envoy for International Energy Affairs. He understands how these investment decisions actually get made. His assessment of Trump's $100 billion ask, he called it fantastical. Goldwyn explained that major oil companies aren't going to invest single-digit billions, let alone tens of billions, without three things: physical security for their personnel and equipment, legal certainty that their investments are protected, a competitive fiscal framework that makes the economics work. Venezuela currently offers none of these. His estimate: smaller independent companies might put in around $50 million each over the next year. Useful perhaps, but nowhere near the transformational investment Trump is describing. So when you hear the $100 billion figure, understand what it represents. It's not a realistic projection, it's a political number designed to sound impressive. The actual capital flowing into Venezuela, if it flows at all, will be a tiny fraction of that amount. Here's where this story gets genuinely complicated, and it's the part that most coverage is missing entirely. President Trump isn't just asking companies to invest in Venezuela. He's proposing something far more radical. During the meeting, Trump told the executives directly, and I want you to hear these exact words: "You're dealing with us directly. You're not dealing with Venezuela at all. We don't want you to deal with Venezuela. Stop and consider what that means." The United States is claiming effective control over another nation's oil resources, not through partnership, not through negotiation with the sovereign government, but through direct administration. The administration has already seized Venezuelan oil tankers. They are establishing a sales process for Venezuelan crude managed by American entities. Trump posted on Truth Social that Venezuelan authorities will turn over to the U.S. between 30 million and 50 million barrels of sanctioned oil, which will then be sold at market price with proceeds controlled by the U.S. government. This is unprecedented in modern history, and it raises questions that nobody has clear answers to. Here's the first problem. Trump recently signed an executive order that prohibits U.S. courts from seizing Venezuelan oil revenues. His reasoning? Such seizures would interfere with American foreign relations and international goodwill. But think about that from the perspective of ConocoPhillips and Exxon. These companies have spent years in international arbitration. They've won legal judgments. They were counting on American courts to help enforce those judgments to seize Venezuelan assets as payment for what they're owed. Now the president has essentially declared those legal mechanisms are off the table. So the companies that Trump is asking to invest billions are the same companies he's just told they can't collect the billions they already owed. You can see why the executives might be confused about the message. Ryan Lance from ConocoPhillips addressed this directly. He called for a complete restructuring of Venezuela's energy system, including PDVSA, the state oil company. He emphasized that the banking sector would need to help restructure Venezuela's debt and provide billions in new financing. In other words, he's saying the entire framework needs to be rebuilt from scratch before serious investment is possible. That's not a one-year project. That's not even a 5-year project. We're talking about fundamental institutional reform in a country that currently doesn't have an elected government. And that brings us to the political uncertainty that hangs over everything. Venezuela is currently led by Delcy Rodriguez, who served as vice president under Nicolas Maduro. She's functioning as interim leader, but there's no constitutional process underway. There's no clarity on elections. There's no roadmap for what comes next. If you're an oil executive considering a 20-year investment, because that's what major energy projects require. You need to know who you're dealing with. You need to trust that contracts signed today will be honored a decade from now. Right now, nobody can provide that assurance. Let me give you a historical comparison that illuminates the challenge. After the invasion of Iraq, the United States made similar promises. Iraqi oil revenues would fund reconstruction. American military presence would provide security. International oil companies were invited to invest. Those companies were extremely cautious. Despite active U.S. military protection, boots on the ground controlling territory, production recovery took more than a decade. And here's the critical difference. Iraq's legal framework, while challenged, was still more stable than what Venezuela offers today. Iraq had a functioning government. Flawed as it was, Iraq had established ministries, however corrupted. Venezuela has an interim leader, frozen bank accounts, collapsed institutions, and $12 billion in unpaid debts to the very companies being asked to invest. The scale of the ask versus the reality of the conditions, this gap is enormous. There's one exception to the corporate skepticism, and it's worth examining. Chevron never left Venezuela. When other majors pulled out, Chevron maintained joint ventures with PDVSA under special licenses from the US government. They kept their equipment in place, they kept their relationships on the ground. They kept operational infrastructure functioning. Mark Nelson, Chevron's vice chairman, offered the most optimistic view at the meeting, saying Chevron could increase production by 100%, essentially immediately, and grow output by about 50% within 18 to 24 months. But here's what you need to understand about that claim. Chevron is playing a different game. They have assets in place, they have established operations, they're not starting from zero. Exxon and ConocoPhillips would be entering a country that expelled them, seized their property, and never compensated them. They would need to rebuild everything from scratch: physical infrastructure, workforce relationships, legal frameworks, security arrangements. Chevron can talk about quick increases because they're already inside the building. Exxon and ConocoPhillips are standing outside a building that burned down their previous investment and now wants them to rebuild it with no insurance and no lease agreement. These are fundamentally different situations, and lumping them together creates a misleading picture of what's actually possible. Let me bring this down to the level that actually matters: how real people are affected by this standoff between political ambition and economic reality. For American families, President Trump explicitly promised that investing in Venezuelan oil would deliver even lower energy prices to Americans. That was the selling point. That was the justification. Energy analysts are pushing back hard on that promise. Claudio Galimberti, chief economist at Rystad Energy, points out that break-even prices for Venezuelan projects are around $80 per barrel, while current global crude prices hover around $60. The reasoning is simple. Even under the most optimistic scenarios, maximum investment, perfect execution, complete political stability, meaningfully increasing Venezuelan production takes years. The infrastructure damage is too severe for quick fixes. Consider a typical American family spending $400 monthly on gasoline and energy costs. They're hearing promises of relief. Politicians are telling them help is on the way. But the timeline for any Venezuelan oil reaching US markets in significant volumes isn't measured in months. It's measured in years, and that's assuming everything goes right. Meanwhile, oil prices remain at 4-year lows, and the political focus on Venezuela may be distracting from domestic energy policies that could provide more immediate impact. The market reality: current global oil supply exceeds demand by approximately 1 to 2 million barrels per day, twice Venezuela's total current daily production. This oversupply is keeping prices low, which paradoxically makes Venezuelan investment less attractive, even as Trump promises companies will profit. Stock markets reflected this skepticism. Following the White House meeting, energy sector stocks traded relatively flat. Investors aren't betting on major capital flowing to Venezuela anytime soon. When major investment decisions are delayed and political conditions remain uncertain, oil companies cannot make long-term supply commitments. They can't plan expansion. They can't commit to production targets. This uncertainty keeps global energy markets tighter than they would otherwise be, and tighter markets mean higher prices. The irony is that the political instability around Venezuela, the very situation Trump is trying to resolve, may itself be contributing to elevated energy prices. Let me map out what we're likely to see in the coming months. I'm offering possibilities based on current evidence, not predictions I'd bet my savings on. Near term, next 3-6 months. Expect continued negotiations between the administration and oil companies. The White House needs to show progress. The companies need to appear cooperative while avoiding actual commitments. Smaller independent firms will likely announce preliminary agreements to conduct technical assessments in Venezuela. These announcements will generate headlines. The actual capital deployed will be modest millions, not billions. Chevron will probably announce production increases from their existing operations. Mark Nelson's claim about doubling output may be optimistic, but some growth from their established base is plausible. What you will not see is major capital commitments from Exxon, Shell, or the other supermajors. The conditions they've demanded, legal certainty, contract protections, resolution of past debts, simply don't exist and won't be created quickly. Medium-term 6-18 months, legal challenges to Trump's executive order on Venezuelan revenue seizure will begin working through federal courts. ConocoPhillips and Exxon have federal judgments entitling them to collect debts. Can the executive branch simply declare those judgments unenforceable? Constitutional scholars suggest this raises serious separation of powers issues. Courts, not presidents, traditionally determine how legal judgments are enforced. This litigation could take years, and every day it continues, uncertainty grows. Analysts estimate that with relatively modest investment, $10 to $20 billion, Venezuela could add around 500,000 barrels per day within a couple of years, bringing production to approximately 1.5 million barrels per day. Energy analyst Dan Pickering predicts Venezuela could realistically raise its production by 50% within 3 years, but that would still fall well short of historic volumes. Helpful at the margins, but not transformational. For American consumers, the bottom line is straightforward. Gas prices will not be meaningfully affected by Venezuelan oil for a long time. The infrastructure problems are too severe. The political obstacles are too significant. The investment needed is too massive for quick fixes. The political aftermath. Days after the meeting, Trump told reporters aboard Air Force One, "I didn't like Exxon's response. We have so many that want it. I'd probably be inclined to keep Exxon out. They're playing too cute." This threat to sideline the world's largest publicly traded oil company reveals the growing frustration in the White House when corporate arithmetic doesn't align with political ambition. Republican lawmakers will praise aggressive action. Democratic critics will question the legal basis and challenge unrealistic promises about gas prices. Senator Chris Coons captured the skeptical view. Military intervention doesn't magically fix decades of infrastructural decay and institutional collapse. This is far more complicated than the administration is acknowledging. He's right. It is more complicated, and no amount of political will can override the basic math of rebuilding a collapsed industry in an unstable country. Let me bring this together with 3 points you should take away. First, President Trump is requesting $100 billion in oil investment for Venezuela. The CEO of America's largest oil company stood in the White House and called that country uninvestable. That single word coming from someone with fiduciary responsibility to shareholders, someone who operates globally in challenging environments, tells you more than any political speech about what the risk calculation actually looks like. Second, Venezuela possesses the world's largest proven oil reserves, but currently produces less than 1% of global supply. Production has collapsed over 70% from its peak. Infrastructure has disintegrated. Technical expertise has fled. Estimates suggest $183 billion over a decade or more just to restore capacity to historical levels. The $100 billion figure isn't ambitious. It's disconnected from operational reality. Third, American consumers should not expect lower gas prices from Venezuelan oil anytime soon. This isn't pessimism. It's arithmetic. Even under best-case scenarios, significant production increases take years. The promises being made today are creating expectations that cannot be met on any reasonable timeline. The core lesson here extends beyond Venezuela. Political will, even backed by military force, even backed by seized assets and controlled revenues, cannot override economic fundamentals. When corporations, with fiduciary duties to shareholders, refuse to invest, that tells you everything you need to know about how professionals assess actual risk versus political rhetoric. Markets don't care about speeches. They care about returns and risks. Right now, the risks in Venezuela overwhelm any potential returns. That's where things stand, and that's what you need to know. Still your guy Innocent? Don't forget to hit the subscribe button, comment, like, share, and turn on your notification button to receive more financial news and commentaries. See you on the next one.